Have you ever wondered why the news talks about the Federal Reserve raising or lowering interest rates? Or why the government seems to be able to influence how much money is circulating in the economy? It all comes down to something called monetary policy. And understanding it is crucial, especially for those of us here in the US, because it impacts everything from your savings account to the price of a new car. So what exactly is monetary policy? Simply put, it's the actions undertaken by a central bank, in our case, the Federal Reserve, often just called the Fed, to manipulate the money supply and credit conditions to stimulate or restrain economic activity. Think of it as the Fed's toolkit for keeping the economy on track. They're trying to manage two key things: stable prices, meaning controlling inflation, and maximum employment. It's a delicate balancing act. Why is this relevant to you? Well, let's say the economy is slowing down. Maybe businesses are laying off workers and people are spending less. The Fed might step in to ease monetary policy. This usually means lowering interest rates. Lower rates make it cheaper for businesses to borrow money to expand and for individuals to borrow for things like homes and cars. That increased borrowing and spending can give the economy a boost. On the flip side, if the economy is growing too quickly and prices are rising rapidly, that's inflation. The Fed might tighten monetary policy. They'd likely raise interest rates to make borrowing more expensive, cooling down spending and curbing inflation. It's like applying the brakes. Now let's dive into how the Fed actually does this. There are a few key tools they use, but the two main ones revolve around interest rates and the money supply. Let's start with interest rates. The Fed doesn't directly control all interest rates in the economy. Instead, they target something called the federal funds rate. This is the rate banks charge each other for overnight lending of reserves. When the Fed raises or lowers this rate, it influences other interest rates throughout the economy, like those on mortgages, car loans, and credit cards. Imagine you want to buy a house. If interest rates are low, your monthly mortgage payment will be lower, making the house more affordable. More people can afford to buy, driving up demand and potentially increasing house prices. But it also encourages economic activity, as people have more disposable income after their mortgage payments. Now, let's talk about the money supply. This refers to the total amount of money in circulation in the economy. The Fed can influence this through things like open market operations. This involves buying or selling government bonds. When the Fed buys bonds from banks, it injects money into the banking system. Banks then have more money to lend out, increasing the money supply. Think of it like adding water to a pool. This encourages economic activity. When the Fed sells bonds to banks, it takes money out of the banking system. Banks have less money to lend, decreasing the money supply. That's like draining some water from the pool. It slows down economic activity. Another tool is the reserve requirement. This is the percentage of deposits banks are required to keep on hand, rather than lend out. If the Fed lowers the reserve requirement, banks can lend out more money, increasing the money supply. If they raise it, banks have to hold on to more, decreasing the money supply. Let's illustrate with a simple example. Imagine a small town with only one bank. Let's say the Fed wants to stimulate the economy. They buy $1 million worth of government bonds from the bank. The bank now has an extra $1 million. It can then lend out this money to local businesses and individuals. Those businesses might use the loan to expand, hiring more workers. Individuals might use the loan to buy a new car or renovate their homes. This increased spending boosts the town's economy. On the other hand, if the Fed wants to slow things down, they might sell bonds, taking money out of the banking system, reducing the amount of money available for loans and spending. It's important to understand that monetary policy isn't a perfect science. There's often a time lag between when the Fed takes action and when those actions have a noticeable effect on the economy. It can take months, even years, to see the full impact of a policy change. Plus, many other factors influence the economy, making it difficult to isolate the effects of monetary policy. Global events, consumer confidence, and technological advancements all play a role. So to quickly recap, monetary policy is how the Federal Reserve manages the money supply and interest rates to promote stable prices and maximum employment. They do this through tools like adjusting the federal funds rate, open market operations, and reserve requirements. These actions impact borrowing costs, the availability of credit, and ultimately, the overall health of the U.S. economy. It's a complex system, but understanding the basics can help you make more informed financial decisions and better understand the economic news. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.